Picture 30 years at a trading desk, 60,000 hours of your one life. Barber and Odean tracked 66,000 households and found the most active traders earned 11.4% a year, while the market handed 17.9% to people who did nothing. Your 60,000 hours are someone else's commission revenue. If you are a self-directed investor in your 40s or 50s who has spent years building a portfolio and is now wondering whether retirement is finally the moment to go all in on active trading, this is not a discipline problem you need to solve. It is an arithmetic problem that was already solved in the year 2000. You just were not told about it. The math behind this is uglier than most retirement planning conversations will ever acknowledge. Let me explain what Barber and Odean actually found, why the mechanism works against you, no matter how smart you are, and what the protocol looks like on the other side of this. Because if you are sitting on $500,000 or more, and you are thinking that retirement finally gives you the time to do this right, the numbers I am about to show you will completely reframe what doing this right actually means. Before we get into the study, if you want more deep dives that respect your intelligence and your portfolio, subscribe to the Paycheck Lab. It is the best return on your time you will get on this platform today. Now let me show you the paper that should have ended this conversation decades ago. In 2000, Brad Barber and Terrence Odean published a study in the Journal of Finance called "Trading is Hazardous to Your Wealth." They were not writing a column, they were not making a YouTube video. They analyzed the actual brokerage records of 66,465 households over 6 years from 1991 through 1996. Real accounts, real trades, real outcomes. Here's what they found. They divided all the households into 5 groups based on how frequently they traded. Think of it as 5 bars on a chart, ranked from the people who barely touched their portfolios on the left to the people who were in and out of positions constantly on the right. The bar on the far left, the quiet holders, performed close to the market return of 17.9% a year. The bars shift as you move right. Each group that traded more frequently earned a little less. By the time you reach the 5th bar, the most active group, the annual return had dropped to 11.4%. The bars do not zigzag. They slope. One clean, steady line from left to right, pointing down. That is 6.5 percentage points of annual underperformance. Every year, consistently, and the mechanism is not mysterious. Barber and Odean named it directly: overconfidence, not carelessness. Not ignorance, overconfidence. The most active traders believed they had an edge. They believed their research, their timing, the reading of the market gave them an informational advantage over other participants. And that belief caused them to trade more. And trading more caused them to lose more. Here is the specific mechanism. Every time you buy and sell a stock, you pay the bid-ask spread. That is the gap between what the market will sell to you and what it will buy from you. On a single trade, it seems negligible. Across hundreds of trades per year, it becomes a structural drag on your returns. Then there is short-term capital gains tax. Any position you hold for less than 1 year gets taxed at your ordinary income rate, not the lower long-term rate. For someone in the $80,000 to $200,000 household income range, that is a 22 to 24% federal tax on every profitable trade. A long-term index investor pays 15% on gains held over a year. That gap, 7 to 9 percentage points of additional tax drag, compounds against you year after year. And then there are the errors. The trades entered on the wrong side of a news event. The positions held too long because of the disposition effect, which is a documented tendency to sell winners too early and hold losers too long. The overweighting of recent information. The pattern recognition that finds signal in noise. Each of these behavioral tendencies shows up in the data. Each one costs money. None of this is a character flaw. Barber and Odean were explicit about that. These are systematic, predictable errors that intelligent people make because the market is designed in a way that makes them feel correct. Now I want you to hold that 6.5-point gap while I show you what it means in actual dollars over the kind of time frame we are talking about. Let me introduce you to Marcus. Marcus is 62 years old. He spent 30 years as a civil engineer. He was disciplined. He maxed out his 401k. He lived below his means. He arrives at retirement with $500,000 in a brokerage account and a plan. He has always been interested in markets. He has been a serious reader of financial news for years. He has watched his neighbor Claire talk about index funds for a decade, and it always seemed passive to him. A little too hands-off. Marcus was building. Now Marcus has time. He has capital. He has a home office. He is going to do this properly. In this model, Marcus puts in roughly 40 hours a week. That is a reasonable assumption for someone treating this like a real job. 40 hours a week, 50 weeks a year is 2,000 hours, over 30 years of a potential retirement. That is 60,000 hours. To be clear, that is a model I am building to illustrate the time cost. I'm not citing a study that tracked 60,000 hours of trading. I am asking you to hold that number as a unit and ask what it actually buys you. Marcus earns 11.4% per year on his $500,000, which is what Barber and Odean found for the most active cohort. That is gross before taxes. After short-term capital gains at 22%, his effective after-tax return drops to roughly 8.9%. Subtract 3% inflation, and his real purchasing power return is approximately 5.9% per year. After 30 years, his $500,000 grows to approximately $2.8 million in today's dollars. Now look at what Claire does with the same $500,000 on the same day. She opens a total market index fund. She sets up automatic dividend reinvestment. She closes the laptop. She does not track daily prices. She does not read the pre-market report. She reads novels. She tends her garden. She travels. She earns the market return, which we will hold at 7% real after accounting for a 15% long-term capital gains rate. After 30 years, her $500,000 grows to approximately $3.8 million in today's dollars. The gap is roughly $1 million. Claire has $1 million more than Marcus. Marcus spent 60,000 hours to produce that result. Claire spent approximately zero. This is what I call the invisible wage. Every hour Marcus sits at his trading desk, he is paying himself a deeply negative hourly rate, not because he is bad at math, not because he is undisciplined, because the system he is competing in is structured to extract value from active participants and transfer it to patient ones. The commission structures, the bid-ask spreads, the tax code, the behavioral biases are not neutral. They compound against the person who shows up every day believing effort produces results. You might be thinking, but Caspian, the study is from 1991 to 1996. Markets are different now. Information is faster. Execution is cheaper. Commission-free brokers changed everything. This is the strongest version of the counter-argument, and it deserves a real answer. Zero-commission trading did lower one layer of cost. That is real. But zero commissions did not eliminate the bid-ask spread. It did not eliminate short-term capital gains tax. It did not eliminate overconfidence. In fact, researchers studying the post-commission-free era have found that lower friction tends to increase trading frequency, which increases exposure to the remaining costs. More recent data from regulators in Brazil and Taiwan shows failure rates among active retail traders ranging from 80 to 97% over multi-year periods. FinRe data in the United States shows 72% of day traders lose money in any given year. These numbers come from a different era with cheaper tools and faster data. The slope of Barber and Odean's bar chart is still pointing the same direction. There is also a small group of people for whom active trading genuinely works. Let us name that directly. Somewhere around 1 to 3% of active traders show consistent profitability over multi-year periods across various studies. These are people who usually have either a genuine structural edge or who have spent years developing and testing systems with rigorous discipline. If you've been actively trading for more than a decade with documented results that consistently beat the index net of taxes and costs, this analysis may not fully apply to you. That group is real. It is also genuinely small. And the survivorship bias around it is enormous. For every person in that 3% who is visible and vocal about their success, there are dozens who tried the same approach and are not talking about it anymore because they went back to work. One legitimate exception worth naming: if you trade exclusively inside a Roth IRA, you eliminate the short-term capital gains tax drag entirely. Gains in a Roth grow and can be withdrawn tax-free. That removes one of the three primary structural costs. It does not remove overconfidence. It does not remove the bid-ask spread. And it does not change the Barber and Odean finding that more activity correlates with worse outcomes. But it does narrow the gap. If Marcus traded only inside his Roth, his real after-inflation return climbs to roughly 8.4%. His $500,000 grows to approximately $5.1 million over 30 years. Still behind Claire's $3.8 million under the taxable comparison, but the gap closes when both accounts have the same tax treatment. The shelter helps. It does not close the arithmetic entirely. The 6.5-point performance gap is still there, sitting underneath the tax question. So what does the protocol look like from here? Step 1 is run the actual comparison on your own numbers. Take your current portfolio value. Apply 7% real return for 30 years if you hold an index fund and do nothing. Then apply 5.9% real return if you trade actively after taxes in a taxable account. The gap that appears is your personal cost of staying active. Write that number down somewhere, you will see it. Step 2 is separate the financial return from the psychological one. If trading brings you genuine enjoyment, if the research and the execution and the engagement with markets is something you value the way some people value golf or cooking, that enjoyment has real value. The question is whether you want to pay for it out of returns or out of a separate discretionary budget. One structure that works is a dedicated trading account with a defined ceiling. Say 5 to 10% of your total investable assets that you can trade actively as much as you like. The rest stays in low-cost index funds, untouched. You get the engagement. The damage is contained. You can run a real scoreboard and see honestly whether your active account beats the passive one over time. Step 3 is reframe what retirement time actually costs. Marcus's 60,000 hours over 30 years is not just a financial calculation, it is a life calculation. The question is not only what return those hours produce in the market, it is what else those hours could produce outside of it. The most valuable thing retirement gives you is unstructured time, the ability to decide each morning what the day is for. The moment you sit down at a trading desk at 9:30 in the morning because the market is open and you feel you have to watch it, you have recreated a schedule. You have given the market a claim on your mornings. That is a cost that does not appear in any brokerage statement. The Paycheck Lab exists for exactly this kind of conversation. The decisions that feel financially sophisticated on the surface but have a different structure underneath. If you are a self-directed investor in your 40s or 50s who wants more of these deep dives, hit subscribe. We publish one of these every week. Here is the question I want you to sit with. How many hours are you honestly planning to spend on active trading in the first year of retirement? Multiply that by your remaining years. Then ask whether the gap between 11.4% and 17.9% compounded over that entire period is the return you want on those hours. Drop your honest number in the comments. Not your net worth, just the hours. I want to see what people are actually planning. Barber and Odean gave us the answer in 2000. The most active traders finish last, not because they are undisciplined, because the system is designed to extract from activity and reward patience. Claire does not beat Marcus because she is smarter. She beats him because she stays out of the way of a process that works when you leave it alone. I am Caspian. Thanks for watching The Paycheck Lab.